And so what we're going to cover today are ways that you can be effective as a realtor in terms of tax savings, in terms of incorporating, in terms of running your business like a business. This is essential information. We're going to wait just about another 20 seconds for some people to jump on the call. But we are ready to live. If in the event that you have a question, because we are live, I would love it if you would just post it. We're going to let Joanne and Marina do all the talking. But if you have a question, I'll interject. I'll jump in and say, hey, this is a question that's coming in from the audience. This is an excellent opportunity for you guys. In 2012, I paid $42,000 in taxes to the United States government that I simply did not need to pay to the United States government. And unfortunately, there was no way for me to go get that back. But it was because I was too busy and too lazy and just didn't understand what it took at that time to incorporate and what the value of that was. That's what we're going to fix today for hopefully a bunch of you who are watching. So you will notice that we do have both Marina Parkin and Joanne Kuntz on the call today. They are CPAs with Kuntz and Parkin CPAs here in Sarasota. They're excellent. A big part of their business runs service towards realtors, and we appreciate that. So they're very specialized. They know exactly what they're talking about. Now, I love them because they're both very talented and very smart. With that said, I'm just going to turn everything over because nobody wants to hear me talk, but they're here for you guys.
Well, thank you so much for having both of us. It's not really any more fun to hear me talk because, you know, I'm both a lawyer and a CPA, and nobody likes lawyers or accountants, really. Certainly not to hear them talk. But I always tell people whenever I deliver this talk that, you know, you have a lot of opportunities to engage in education, and oftentimes they're telling you how you can work harder, how you can do more, how you can use Facebook in your marketing, and how you can better use your photography and listings. And it's always about what you can do more of. I don't want you to work harder. I don't want you to do more. I just want you to keep more of your money and reduce your liability. Oftentimes people think, you know, it's not going to happen. No one's going to sue me. Nothing's going to happen. Plus I have E&O coverage from my brokerage. So I don't really need a business. I don't need to worry about it because nothing's going to happen to me. I report to you that if nothing's going to happen, why is John Morgan so popular? So Morgan & Morgan is one of the biggest law firms in the country for a reason, because stuff happens all the time. And they always say you're not in business unless you've been sued. Mm-hmm. So you're in this real estate business. A lot of times people get into this as a second or third career, and they've had a fulfilling career in something else, and now they're moving on. So if you have prior business experience, you will have a leg up. If you do not have prior business experience, you should not hide under the bed. This is not, there are resources available to help you navigate the waters very much more safely in a business entity if you avail yourself of those protections. Not to mention, with the current environment of what's going on, we have had a lot of realtors that we've worked with who have met with frustration when it came to applying for PPP loans because they didn't have a business structure. It's very difficult to go to the SBA and apply for relief as a business when you don't even have a business checking account. So you can't walk the walk and not talk the talk. So a lot of times I hear people say things like, well, I've talked to my accountant and they said it's really not worth it to form a business. We're going to talk about all of those types of objections and help you decide whether you should be doing this or not. So when it comes to, should I have a business entity for my real estate practice, a few considerations to make are, number one, the tax benefits. There's certain types of tax elections that you can only make if you've got a business structure. There's certainly liability protection. Again, Morgan & Morgan for the other people. Future goals, business planning in terms of how are you going to grow the business, maybe sell off the business, so that you're not just working a job that you happen to be the boss of, you actually are building a business. We'll talk about the expense. How much does this cost to get set up? How much does it cost to administer on an annual basis? And then insurance is a big key component to whether or not you should have a business entity. Now, when I say business entity, I'm talking about how you hold your real estate license. So I can be Joanne Kuntz, realtor. If you pull out your license from DeBeeper, what does it say? Or I could be Joanne Coons PA or Joanne Coons PLLC. What's the difference? PLLC is a professional limited liability company. That means the professional designation means I have to have a license to do the job. So my firm, Coons and Associates, PL, Coons and Parkin CPAs, PLLC, we are PLLCs because we have to have a license to be an accountant and a lawyer. Same thing with the realtor. If you are new to the business, you'll see as you're looking around that many of the seasoned agents are Joanne Coons PA. And PA stands for Professional Association. That is a corporation for state law purposes where you are required to have a license to do the job. So the difference between PA and PLLC is simply, are you an LLC or a corporation? The differences practically to you are very minimal. The liability protection, the ability to keep any acts of the business outside of your personal accounts for attachment in the event of a liability or a judgment are almost the same. However, there's a little bit more paperwork associated with the PA or the corporation. You are required to hold an annual meeting. You are required to keep minutes of that meeting. Got to be careful. People will say, "Oh, am I going to have a meeting with myself? I'm the only owner of this company." But that's still important. It's still a corporate formality that you must observe. And the failure to have those meeting minutes in your files, they don't get recorded anywhere. They're not published anywhere. But the failure to have those in your corporate records definitely is a chink in the armor of protection that you're looking for. So if you have an existing PA, should you switch over to PLLC? Probably not. But if you are just getting started out of the gate, for as much paperwork as realtors are expected to handle, they have a tendency to run away from it when it's dealing with their own business. So I always recommend, if you are going to have a corporate structure, that you look at the PLLC if you are just coming out of the gate. The reason that you see the seasoned agents as PAs rather than PLLCs is it was about 10 years ago that FREC finally said that an agent could use an LLC. Before that, you didn't have a choice and you had to be a PA. So those are some considerations, with respect to what type of entity should I form. You're still going to have to file an annual report for both businesses. That annual report is due May 1st. It's an online form where you just enter in your credit card number and renew. It's $138 a year, whether you have the LLC, the PLLC, or the PA. Both, whether you do PLLC or PA, both require a separate tax ID number for IRS purposes and EIN. Separate bank account required for both. So we don't want to be commingling funds. That's probably Mr. Morgan's favorite thing, besides medical marijuana, is commingling of funds. Commingling of funds means you're paying business expenses from a personal checking account, or vice versa, personal expenses being paid from the business checking account. Now, what we don't want to see is we pay the mortgage for your home out of your business account. We also don't want to be paying for business expenses out of the personal account. Either way is just as bad. The reason people commingle typically is out of convenience. They will find like the mortgage is due and the money is sitting in the corporate checking account. So therefore I'll just pay the bill out of that business checking account. We don't want to do that. The more proper way to handle that is by a distribution. You want to take that money and literally online transfer with your bank from the corporate bank account to the personal bank account, and then cut a check for the mortgage out of the personal checking account. That's the proper way to handle that. Moving money between the business and the personal accounts is perfectly fine. If you are taking money personally from the business, that's a distribution. If you are putting money in to cover the business expenses, that's a contribution. Marina can talk a little bit about the importance of that in just a minute, but that tracking when it comes to your bookkeeping side is going to be important so that you don't pay tax on that money twice.
So let me ask you this, Joanne. So at the end of the day, we're all running businesses, right? And when we're talking about running our businesses, for a lot of realtors, that's us, right? Yeah. We're a one-man show. A lot of us, we work for our company pays us. And so, but I want to make sure that we're not confusing the brokerage in general with the individual business that we're running as independent contractors, because they're different, right? And the IRS is going to look at them differently, correct?
Absolutely. And so is Morgan & Morgan. If you want the liability protection to say, hey, you can't come after me personally because I have this business, then you need to behave like a business. You won't be protected if you're not observing the corporate formalities. So your engagement in your real estate business is exactly the business we need to protect. And it needs to be operated that way. It's easy for people to say, it's just me. That's exactly what Morgan & Morgan is going to argue if there's a car wreck, if you're out showing property and you're in a car accident. If I had one agent who was showing property on Longboat, a higher end piece of property, she had the buyer. The buyer fell down a staircase, was very badly injured, required a hip surgery. He was an older gentleman, not in great health. And he sued her brokerage, the listing brokerage, the listing agent, and the selling agent. Fortunately, the selling agent has her PLLC. We had set it up, and she was dismissed quickly from the lawsuit. But if you don't have that protection, then you have a tendency to get hung around longer, and it costs money to fight. Even if you aren't ultimately held liable, the disruption, the stress, the participation in that lawsuit for whatever period of time you're involved is keeping you from listing appointments and home inspections and parts that do get you paid. So it's very important that you treat this business like a business, even if it is just you. One of the ways in which Morgan & Morgan, and I pick on them because the ads make it easy to, but any of the civil litigation attorneys are going to be looking to pierce the corporate veil. That's the legal term for get inside the company to the owners for liability. So if you are out showing property, they know that there's not a lot of assets in your PLLC, maybe a computer, maybe a car and a bank account. So they're going to try to get to you personally if you have rental properties or investment accounts or anything that's not protected, like IRAs, 401ks, life insurance policies, things like that. They're going to try to get to those assets because it's an easier way to collect. That process is called piercing of the corporate veil. In order to pierce, they will look to two things. Alter ego, which is an argument to say there's no difference between you and the company. I don't see you using the company name. I don't see a big distinction. There's commingling. I don't see a distinction in the checking accounts. I can't tell the difference between Joanne Kuntz, the person, and Joanne Kuntz PLLC. So it's just an alter ego or a nickname. That is the argument that they are happy to make because it's people litter the landscape with opportunities to make that argument. Every single time that I talk to somebody about this and they say, well, it's just me. That's exactly what Morgan & Morgan is trying to argue. It's just you. So don't do that for them. Don't do your banking that way. Don't do your corporate documentation that way. And say, well, it doesn't matter. I don't need an operating agreement. It's just me. Don't say it's just me ever, because it's a really hot way to get in trouble.
I'd like to also jump in here and say that we have a lot of clients who come in, particularly the ones like Joanne mentioned, if it maybe they're a second or third career, or they have had businesses in the past, and they were always used to operating as a corporation. And a lot of people still believe that to really get that legal liability protection, you really truly have to be a corporation. And people listen to and read and they Google around, and ultimately, and they don't understand what a LLC or a PLLC is, and whether it's an old entity that they have or they go and form a new one. So Joanne, can you just reinforce a little bit on the corporation versus the PLLC and the equal legal liability protection that it gives you? Because there's still a lot of confusion around that issue.
Oftentimes people will say, well, I'll start as an LLC, and then if it gets bigger, I'll become a corporation. Google is an LLC. You cannot really get bigger than Google. Maybe Sam's Club, maybe Walmart. But it's not about sophistication. So back in the day, corporations were kind of the forerunner of entity structure. And I'm talking when the US was first formed. And if you talk about corporate structure, you'll hear people talk about Delaware. Delaware is famous for its corporate law. So back then the choice was corporation, which gave you complete unlimited liability protection.
We're having a little bit of a technical difficulty. For whatever reason, it seems like it's just frozen on Facebook.
Okay.
So hold on just 1 second. Let me try to refresh our feed and give me just a moment.
And if you talk about corporate structure, you'll hear people talk about.
All right. Let me see. It looks like we might be going now.
Delaware is.
All right. I'm sorry about that. Let's try
Delaware.
to get back up. It seems like it just refreshed.
What's good in Delaware? Not the food. No, I'm just kidding. So in Delaware, that was kind of the birthplace of corporate law. And that's always been where people have deemed it to be the most protective. Florida has mirrored a lot of the Delaware rules. So we've got good corporate protection. The flip side back in the day was a partnership. With a partnership, you had to have more than one person, which you can't have in real estate. And there had to be at least one partner who was available for unlimited liability on behalf of the company. So there was always one partner that could go down on behalf of the company. Those used to be your only two choices. The benefit to the partnership was it was more flexible. The benefit to the corporation was it was more protection. 25, 30 years ago was born the LLC, the limited liability company. And it's a marriage of the corporation and the partnership. The LLC has the flexibility of the partnership, but the unlimited liability protection that the owners of a corporation enjoy. So it became popular very quickly. It's my preference for our clients because you aren't required to hold the annual meeting and keep the minutes. There's just a little bit less paperwork requirement. It's a great idea. It's best practices to still document those things, but it's not going to serve as a deficiency if you're in a lawsuit. Whereas in a corporation, if the judge asks, where are your corporate documents, and you don't have your meeting minutes and those documents, you are going to have less protection. And those are not, all or nothing. It's not like the turning point for the company, but the more things that look like you're not behaving like a company, the more likely you are to have that penetration of the corporate veil. So I prefer the LLC if we're coming out of the gate. But like I said, if someone already has a PA, then what I would suggest is that you not go through the hassle of changing to a PLLC. But if you have not been keeping your corporate meeting minutes and you go, ooh, I've been doing this for 6 years and I didn't know I was supposed to do it, can you go do that now? Yes, provided there's not the threat or a pending lawsuit. What you cannot do, turns to a felony quickly, is have the lawsuit threatened or issued to you and then run out and doctor up 6 years of meeting minutes. If you do it now before there's any threat of litigation, you're housekeeping. If you do it once there's a threat of litigation, it's a felony. And there's this pesky data mining timestamps inside Word, so it knows when you did them. So from that standpoint, I prefer the PLLC if at all possible. Now, not only are we going to get that liability protection, we have an opportunity to get insurance policies that you otherwise cannot get, umbrella policies that are extremely inexpensive for a fair amount of coverage. Those are particularly nice if we have teams. I'll reserve team talk until the end of this, time permitting, and we can see as Alex fields the questions to get a feel for the audience. If we have a lot of solos or if we do have some teams, we can talk about some particular considerations there. If we run out of time, we can do a separate pop-up on these with respect to teams. So liability protection, insurance, bookkeeping, tax benefits, and the ability to really scale this business and turn it into something that you can hand off when you're ready to exit, that will have some value and can possibly be sold. Those are all the reasons why you should consider forming a business. Now, if you go to your CPA and you ask for legal advice, it's typically not very good because they're not lawyers. So oftentimes people will say, well, I talked to my CPA about it and she said it wasn't worth it. Marina, how many times do you pick up a tax return from somebody who was just told by another practitioner that it wasn't worth it? And what do you tell them? What do you?
It just happened. It just happened an hour ago.
Okay, good.
I talked to somebody at 11 and who sent me over last year's tax return, and I saw how, what they were reporting was on the Schedule C, profit or loss from the business, paying as much in payroll tax as they did in income tax. And they have been doing it for years without anybody ever telling them that there was a better way of doing it. And these are savings that are every year. The tax return looks fine. There's nothing wrong with the tax return. But this is where the tax planning piece of it definitely comes in, is to say, okay, I've got the PLLC. Now what? Now what do I do and how do I take advantage of this PLLC from the tax standpoint. And I think this is where some of that confusion comes in too, from talking to the CPAs, and they say it's not worth it. Well, the legal protection is always worth it. What's nice about having the PLLC in place is that, you know, in order to obtain those tax benefits, we do, and many of you have heard this, an S corporation election. The nice thing is we can wait to make that S corporation election when we see that it's really worth the tax savings. However, we cannot make it if the PLLC has not already been formed and in place. So a lot of times we get a client and we're doing their tax return for the year that just passed, and I'm telling them, oh my God, you could have saved $10,000 in payroll tax. Let's get you an S Corp. And they say, oh, I'm not even a PLLC yet. So I cannot make you an S Corp going back if your PLLC wasn't set up. On the flip side, if we create your PLLC at the beginning and your income is low, and it may not be worth the savings to make you an S Corp from day one, but if we keep an eye on you 2-3 years down the road, all of a sudden you've got 3 big closings. One of them you're on both sides of. And now we're in your tax return and I see that your income has quadrupled from last year. I immediately make an S Corp election for the year that we're working on immediately. And now you're realizing those substantial tax savings from being an S corporation. So it is definitely priceless to be in the right legal structure first, because then as CPAs, we have a lot of flexibility at that time to make the right election at the right time for you guys.
And we can't backdate that. So that
Correct.
closing happens a lot of times when people call me, they're saying, ooh, I'm on both sides of a really big deal and it closes in 3 weeks. I need a PLLC. Well, unless we delay the closing date, you have to be paid on the date of closing how you held your license. And if you don't have your PLLC in place, you can't tell Alex, hold my check, and then when my PLLC comes, then pay me to the PLLC, because that wasn't the licensee who earned that commission on that closing date. So what you don't want to do is put yourself in a position where your best alternative is to go to your client and say, can you please delay closing so I can do some tax planning because I didn't do that at the beginning of the year. That's crazy.
Okay, so what is the tax rate that we're talking about if we go to this S Corp? What is the level? Because it's pretty significant, and I just want to let people know, numbers wise, they can look at their income and just kind of guesstimate where that number would come in.
So the self-employment tax is what's up for grabs. The S corporation flows through, and if you earned $100,000, you're still going to pay income tax on the $100,000 at your bracket, that ordinary income tax rate that people are accustomed to. The self-employment tax portion is 15.3%.
15.3% on top of it. So if we do this $100,000, just to do that math, you're talking about $15,300 extra on top of the income tax that you're already paying, correct?
Absolutely.
Yeah.
So people will sleep in the parking lot at Best Buy to save 10% on a TV on Black Friday, and they don't want to get out of bed to save 15% on their income all year.
And how much?
This is better than the gecko.
How much is it to file with SunBiz for a PLLC?
SunBiz charges $138 a year to maintain this.
$138 versus $15,300. I got it. Okay.
So people will say, well, I'm new. Or do you plan to sell anything? Because if you plan to sell anything, why, I always ask, maybe you fancy to be like Warren Buffett. Warren Buffett, besides being a genius, also felt like he should pay more tax because he's able to. So if you feel that way, then you should wait and not do PLLC and not do S Corp, because you could pay more tax and contribute back to your community.
I love that.
Well,
Contribute right to the government. That's fine. That's fine.
From the technical standpoint too, we've seen all different sizes of businesses and the amount of earnings. So over the years, we've sort of developed our rule of thumb, if you will, where we can really see that it's worth it. So when you move into that S Corp tax filing structure. Sure, you need to file another tax return. It's an S Corp tax return. So you need to pay the filing fee for that. You need to probably be a lot more mindful about creating a system of tracking expenses and so on. That's different. The other thing you have to do is set up payroll. And I want to touch that as a separate issue in a few minutes. But, you know, IRS allows you to save on payroll tax being an S Corp as long as you pay yourself reasonable compensation. Whatever that reasonable compensation is, there's no golden rule. Typically in the service industry, we say about a third should be reasonable compensation. So if we're looking at our $100,000 example, which is an example I often use with my clients because it is easy math, if you bring in $100,000 of self-employed earnings, forget about income tax. As we said, income tax is going to be the same depending on your tax bracket. If you've got 100,000 subject to self-employment tax, that's 15,000. If we only pay you salary of, let's say, $30,000 or $40,000, make that salary subject to 15%. You've just saved yourself 60 to 78,000 times 15%. That's what, about 11 grand every single year. Every single year where your income is at $100,000 level. So it's huge. We can be flexible in salary depending on what else you want to do. For example, you want to increase your pension contribution and need more earned income. We up your salary, give you more pension. That's where the room is to plan. But you got to be already in the structure where we can do the planning. So the savings are enormous. So going back to sort of the number where we see it's really worth it, if your net income is going to be somewhere in the range of 40 grand or so, I would say if you're between 30 and 40, it's time to become an S Corp. Because at that level, the savings from not paying all of that in payroll tax versus running a payroll and doing another S Corp tax return really do the costs outweigh, the benefits outweigh the costs there. But you got to get to that level. So if you are new, and you're only starting out and all you're doing is incurring in expenses and maybe you have one closing, have the PLLC in place. I'll see you next year when you've had those 3 closings and you were on both sides of one of them. And when you come to me next year and now you're at 60,000 net income, I put you in the S Corp, I save you, what, 4 or 5 grand off the bat for that year. Okay.
That sounds awesome. So just to recap a little bit, so if we have this PLLC, if we just go ahead and we spend $187 on sunbiz.org, and before people go doing this and clicking away while they're watching this webinar, I will say that there's a very specific way that you have to do this.
It's a process, not an event.
I'm sure we're going to cover that, Bridge.
Yes.
But before you actually click pay, let's listen to the rest of the seminar, because there is something very important that you have to do in a specific way or it will not count for license law. And and it's a totally separate thing. That's not the IRS. The IRS says you do it however you want. But when it comes to the Florida Real Estate Commission, they have very different rules. But what I will say is that if you have the ability to save tens of thousands of dollars in a year, and if you have the ability to, if something terrible and totally unforeseen happens that is totally outside your control, but to limit your liability in one of those cases, if you could take just a simple step to do that, why wouldn't you take that step? And if it's totally legitimate, if it's a totally good way to do this, and all it is just running your business like a business, and then you don't have to go see John Morgan, why wouldn't you go incorporate and become a PLLC? Why wouldn't you do that? But it happens. And I've never, in my whole career, never ever have I met a realtor in their first year of business, never ever, who says, I only want to make $30,000 a year. I've never seen that.
Correct. No, and in your business, the reality is you can make that in a transaction, and that's not beyond the scope of this is not like $1 million listing New York City style. You can make 30 grand in one transaction here all day. So you can't hide from that. The other thing that people will say is, well, I'll wait till the end of the year. So that way I don't have why have 2 different kinds of, ways of handling this in the same tax year. It's not inconvenient or problematic for you to have part of your income for the year on a Schedule C, which is what you would have as a regular realtor with no company. versus the second half of your year on the S corporation tax return. It's not going to cost you that much more in terms of the tax return preparation. So people will say, should I wait? And I'm like, only if you want to knowingly pay more. It's one thing before you listen to this seminar and know that you're paying more. Once you know it and you continue to stay in those structure, that's the part that I have trouble reconciling, because you feel bad for people when they just don't know. Marina has to drop that news on people like she did at 11 all day long. Like, sorry, if you had done this, I could have saved you. But it's especially disheartening when it's like, yeah, I know you sat in my class 5 times and you didn't get around to it. It's easy to get busy. And the busier you are, the less time you have for us. The less time you have for us, the more you need us. Because if you're busy, that means the clock is running and you're making money.
And this is why we're here. And this is why when you guys come in and you form your entity, and even if I don't put you in the S Corp right away, I'm going to keep my eye on you. I'm going to recommend the bookkeeping system. I'm going to reach out to you before the end of the year to see where you're at, to see what we can be doing. We can work up some estimated payments. We can talk about payroll. We can talk about pension savings. But you know, you've got to be in here so that we can keep an eye on you. It is much harder for us to do anything when you come in February or March for taxes.
Or April 12th.
Correct. Or April 12th. Then I definitely don't want to see you. But we really cannot do anything, and that's when we get you in to plan at least for the year going forward. It is never too late to start, but of course, the earlier you start, the bigger your savings are. I mean, we see these realtors and these structures for years, and they've spent most of their highly productive years paying, overpaying in the self-employment tax. And let me also tell you something else about self-employment tax. People argue with me often to say, well, if I don't pay as much in self-employment tax, does that not mean that my Social Security benefits are going to be lower? Sure, maybe a couple of $100 less when you're going to be 70 years old. But if I'm giving you $10,000 savings today, and you put that in your solo 401k or SEP plan, that is going to way more work for you than building up that Social Security. Because the amount of Social Security income that you're losing from reducing your earned income or income subject to self-employment tax, it's minute. It's minute. You got to think of the savings that you are generating today, investing them in the future, putting them in a retirement account if you didn't count on that money anyway, and let that money work for you the way you want to.
Yeah, it's found money. You don't have to go do another deal. You just save, a couple transactions worth of money simply by changing the form you report the numbers on. One of the rebuttals I get a lot, Marina, is when people say, well, this sounds really complicated and I don't really want to take, that's an administrative burden. But can you talk about the difference in what your bookkeeping should look like if you have no PLLC versus a PLLC? What does the IRS want to look for? You're not really.
It's exactly the same thing. It's absolutely the same thing. If you are a Schedule C, just self-employed individual, you still need to have a great system of tracking all your expenses. Joanna and I have developed this list over the years, and we keep updating it every year. That's called Common Deduction for Realtors, and many of you have seen that list and then the various versions of it over the years. But really, that applies to you whether you started yesterday or whether you are a seasoned S Corp 5 years from now. These are typical realtor deductions, and you got to keep track of it. So unless you've got a good system in place, it doesn't really matter who you are, because at the end of the day, you still want to maximize all your deductions. Since we're on the subject, if you guys don't mind, I'll touch a little bit about on my opinion on the bookkeeping system. So there is many different ways of doing this, right? There's more than one way to skin the cat. And people Google around and they find QuickBooks, and they immediately go out and get QuickBooks file and a subscription, and then they end up finding themselves in the QuickBooks class because they need to know how to use it. Everybody should play at the top of their game. Your strength is to sell real estate. Let the bookkeeper do their job. Okay. If you feel like you don't want to pay the bookkeeper to help you with your business bookkeeping, that's okay. Don't buy QuickBooks. set up an Excel sheet. Anybody can do an Excel sheet. If you've gotten this far in your real estate career, you can set up an Excel sheet. Set up an Excel spreadsheet, put on the left side all of the expenses, and we're happy to circulate that list of expenses to you guys, and track it monthly. Please sit down and do it monthly so that anytime year to date, you can see what you've spent on what. Never mind, no, year to date. How much did I spend on my Zillow ads? Or how much did I spend on Facebook? Or what did I spend?
Marina, oh, I think we're running into some technical issues. Hopefully she comes right back. But
She
doesn't
looks
look like it. She looks like she's pretty paused there.
She's like,
Yeah. All right. Okay. So
well, I can tell you where she's going if you want me to finish her sentence.
That would be great.
So what she's trying to say is it's not only important to know what you spent, but it's important to know why you spent that money. So if you see that you made $7,000, paid $7,000 in Zillow ads and you got no sales out of it, if your expenses are in a shoebox in a heap, you won't be able to make any business decisions based on your financial statements. You can't say, you just know like, oh, I paid $500 a month to Zillow. You don't have any idea what that means with relationship to the income that you're earning and whether or not you should continue to make that expense. And that is a crucial part of operating a business. If you don't participate in those types of decisions and you don't utilize the financial information, you just keep a shoebox and dump the receipts or scan them and you never look at them, you can do that. That's not illegal, but it is certainly not any kind of, nobody is at the board of directors at Google is running that company that way. Otherwise, you're directionless and you're letting the company go wherever. It has no plan, which means you don't know where it's going to end up. So you can't set goals. You can't be intentional or direct about where you want this company to grow. Are you trying to do vacation rentals or beachfront properties or specialize in Lakewood Ranch? You don't know if you can't see any kind of patterns. And that's a really, if you listen to anything from Gary Vee to Dave Ramsey or anything in between, everything is about having a plan and then executing it. And you can't have a plan if you have no idea what you've spent or why. What you spent is one thing, why you spent it is another. We have one client who's a manufacturing client, and they break down their financial statements in a really interesting way. And one thing I always use as an example from them is, if you said, hey, this client spends money on travel, is that a good thing or a bad thing? Should a manufacturing company have travel? Well, to me, it depends. Are they traveling for sales? If every single time they travel, they get new business, then that's a good thing. I want to see sales going up. I want to see travel going up because I should see sales go up behind it. But if the travel is to fix or repair things that didn't go well, I don't want to see that kind of travel go up. So you can't even take a category and call it good or bad. You really need to know why you're spending the money. And you can't do that if your stuff's in a heap in a shoebox.
Yeah. It's always enlightening to me when I go back at the end of the year, and I don't do it honestly as much as I should, just because I'm in one of these lines of work where we're busy and we're doing a million things. And and kind of the last thing that I want to do is go sort through my shoebox. Although fortunately we're past the shoebox stage now. But it's hard to go back and look at those numbers to say this is what we do. But at the end of the year, there are always things that I find where I was spending money where I questioned that expense throughout the year, and I look back and I was like, you know what, I actually did pretty well on whatever that was. And then a lot of the time there are things that I think are going super well, and I was like, wow, my return on that was not nearly what I thought that was. And it always makes me question some of the different things that we're putting together. So that's just part of running a business like a business. That's smart, not just from a tax perspective, not just from a legal perspective. That's just good business.
Yeah. And you can't treat this any other way and expect to be successful.
Right. That's it. That's exactly right. At the end of the day, the people who excel in it are the ones who do treat it just like a business and come across. So earlier I teased, and I want to come back around because we teased it a little bit, and I want to make sure that we don't leave it alone. When we were talking about PLLCs, we were talking about you have to structure it in a specific way, specifically in the title of it. And can you go into that a little bit more?
Absolutely. So, and if you would like, I can distribute to your viewers the worksheet that we always give out if we were live. We do miss everybody, but you know, you just have to, I guess, settle for me on the computer now. But we have 10 steps to establishing your real estate business. You have to be very careful who you're working with, because in real estate, you're in a specific industry. So you can't just talk to any old CPA, because they know the tax rules. The IRS has their own set of rules. The IRS has no idea who Florida Real Estate Commission is, nor do they care, and vice versa. So FREC rules have nothing to do with tax. And if your CPA does not know the FREC rules, you can end up with inadvertently have an issue. Likewise, corporate lawyer, if your business lawyer doesn't know the FREC rules, I can give you really sound business or tax advice that may not apply it may not play well with the FREC rules. So you've got Florida business law, you've got IRS federal tax law, and you've got Florida Real Estate Commission license rules. So those three sets of rules must be complied with. At some points they compete and bang into each other, and they certainly don't talk to each other. So you can't just say, well, I set my business up on Sunbiz, which is the Division of Corporations website in the state of Florida, to start a business, and Sunbiz let me do it, so therefore it must be right. Sunbiz doesn't care what you put on. You could put Mickey Mouse LLC. They don't care. It doesn't make it so. It doesn't mean Disney won't come after you for using their name. You know, it'll as long as you have 138 bucks, it'll let you hit the button. So you have to be careful. So the first thing, if you're going to endeavor upon this, is first we must form the LLC. You should use the designation PLLC. So I should be Joanne Kuntz PLLC. I may be Joanne M. Kuntz PLLC or Joanne Marie Kuntz PLLC. I cannot just say, you know, I really don't love Joanne. It's a really old lady name. I got stuck with it. So I'm just going to be Marie Kuntz. You have no ability to be creative with the name of this company. You cannot say Gulf Coast Realty Group PLLC. That is not, it must be your first and last name with or without middle name or middle initial. That's the only choice you have with respect to the name. I get that a lot from people. I formed an LLC and this is the name of it, and it's some innocuous group name. That's not permissible. That can be your team name. It cannot be the name of the PLLC that holds your license. So once we get that through sunbiz.org, we then need to obtain a tax ID number or employer identification number from IRS. That form is called SS4. You can get it on the IRS website. You can Google the IRS website and it will let you make this application electronically and will spit out your number immediately. Then you have to file a Form 2553 to make an S election to be taxed as an S Corp, as Marina was saying. You have to change your name with FREC. You actually have to get a physical new license in the mail. Your license number does not change. This is more like a lady getting married. The name changes of the licensee. So my license would move from Joanne Kuntz to Joanne Kuntz PLLC. The second that happens, you've got to notify your broker. You've got to get changed in whatever Form Simplicity or Transaction Desk or whatever software suite you're using. Because now when you populate in the contract as the selling agent or the listing agent, you can no longer be Joanne Kuntz Realtor. Joanne Kuntz, the person, no longer holds a license. The license now lives in the PLLC once you get that new license back from FREC. So we need to complete a W-9 and give that to the accounting department of your brokerage so that they know to actually pay your new PLLC. The brokers are interested in that because if they continue to pay Joanne Kuntz, they are violating 475 by paying someone without a license. So that's a problem. We need to open a bank account for the PLLC and use it. Shocking news. Open it and use it. Deposit your commission checks into that PLLC bank account. Pay the business expenses from the PLLC bank account. At that point, welcome back, MP. At that point, if you need money, you're going to transfer it from the business account to the personal account. And if you need business money because you've just gotten started and you need to do your licensing, you need to take continuing education hours, or you need to pay Zillow or whatever you need to buy, and you don't have any closings yet, so you don't have any business income yet, you can make a contribution and put $5,000, for example, into the business checking account and then pay those business expenses. We want to make sure that we're not commingling, so pay only the business expenses out of there. The bookkeeping system, I always tell people, I don't care if I just care that you're consistent. Like Marina said, if you don't want to hire somebody to do QuickBooks, you sitting at QuickBooks is a disaster and a time waster. So please don't, unless you know what you're doing. And know what you're doing doesn't mean you've typed stuff into QuickBooks before. I mean, know what you're doing, like understand double entry accounting. If you don't understand double entry accounting, you should not be typing in QuickBooks, because all it does is make a mess for you to pay a professional to sort out. I would rather have nothing. I would rather have a colored construction paper system where these types of expenses are yellow and these are blue and these are green, because I can use that to prepare the tax return. I cannot use your tangled up disaster of QuickBooks that you thought you were doing a good job on to prepare your tax return. So it will be cheaper if you use a simple system, Excel spreadsheet, whatever, and convert that over to the CPA to prepare the return, than for you to pollute QuickBooks with inaccuracy.
So is there a system that you would prefer just to help with some of those accounting tracking? So instead of QuickBooks, if someone just wanted to say, you know what, these are the charges that I put on my credit card, is that something that someone can do? And then later on, we can just like categorize that or set up the system to categorize, just to help automate that process a little?
Excel spreadsheet is usually the answer, but go ahead, Marina.
Sorry, and I'm sorry, I got the whole internet just went down. It looks like in a couple of houses around, because the neighbors, we all have a texting message to each other. So I apologize, because I was on a good roll and was talking about the Excel spreadsheet, and then I realized nobody was hearing me.
Well, that's all right.
Well, I finished your roll and then went on to something else, and now we're back at Excel spreadsheets. So it's like you never
I did not miss much.
It's like COVID-19. It's still March 15th.
Exactly. It's a groundhog. It's a groundhog day.
Where will you be in 5 years? June of 2020.
The Excel spreadsheet is great. And what I really want to tell you guys is that it is not just for tax purposes. Please keep track of your expenses so you know what you're spending the money on. That is just as important for you as the business owner than it is for you to sit down on April 12th to compile all of the expenses that you did in a year, because, oh, Marina is going to yell at me if I don't get it to her in time. I'm going to yell at you because you as the business owner have no idea that you spend this much money. And, we get into this discussion all the time, because when I prepare your tax return with the expenses that are put together randomly like this, oh, let me go through my credit card, or let me go through my business banking account or whatnot. First of all, you're going to miss a lot of expenses if you're doing them ad hoc. You're going to miss things that you may have put on 2 cards because you're only looking at 1 card. And you come to me and you say, oh, I swear I had a lot more expenses than this. Why is, I'm overpaying in taxes? A lot of times it's really you doing it a year later, and you really don't remember what you did in February the year before, because now you're a year and a half later doing your tax return. So we understand that everybody gets busy, and especially as a realtor, you have your season as well. But please, if you cannot do it monthly all the time, do it at least quarterly. And if you've got the dedicated business account and a business credit card, then sit down quarterly, consolidate it, make a summary. Another system that we have seen, which is, it's called FreshBooks. It's not QuickBooks in that it doesn't have the double entry. Essentially what it does is that you can upload your bank statement, and it helps you categorize the expenses. And then that can create an Excel spreadsheet, which you can sort. Again, it still requires you to set up expense categories. The other thing that is also helpful is that if you've got a business card that allows you to, or business credit card that allows you to go and set up categories ahead of time. I know Amex does, and I believe, Chase, Visa, you can actually go through expenses and click by category. So at least you're on top of it as often as possible. And, I want to cover something else too. I know we're getting close on time, and I'm not sure if Joanne had touched on it, but where you've got those expenses that are personal use of the business, personal. So stuff like telephone, home office, and the car. We're talking when we talk about commingling, we're talking about, let's say dues. If you have your business dues, your MLS dues, please pay them out of the business account. But your car, you've got the same car that you use personally for business. What do? Do you pay a gas out of your business account and insurance out of your personal account and whatnot? And that will depend case by case basis on how we end up deducting your car. In most of the cases, if we take mileage, then please pay for all your car expenses out of your personal account, but tell your CPA what your mileage was at the end of the year, business mileage, and we will take that as a business deduction. You don't have to worry about paying for gas here and insurance there and repairs in the third place. Same thing with telephone. If you've got the same cell phone you use personal and business, please pay it out of your personal account if you don't have a business account for your phone, and we're just going to allocate business portion and take that. So when it comes to mixed use expenses, it doesn't really matter as long as we take a proper portion of the expense that you use. But anything that's strictly business, all your advertising, all your marketing, promotion, meals, that definitely should all be coming out of your business account. Joanne, do you agree?
Absolutely, absolutely. And one thing I will say to piggyback on that is if you do have a credit card, oftentimes new businesses aren't able to get credit in their name because the business hasn't existed. So it's okay if you allocate a personal credit card toward the business use, even if it has an existing balance. But what you want to do is stop using it for personal use after that. So let's say the card has $5,000 balance on it, and now you say, as of today, this is a business card. That's fine. You can continue to make the payments and pay off that balance, but then any new charges, I want to just be business. What I find is that people get into trouble when they start chasing points. Like, oh, I'll pay for this big expense over here on this card because I'll get points. I promise that the missed deduction costs you more than whatever the free points we're going to give you. Especially now, you can't go anywhere anyways. You don't need the miles. Sit down.
Exactly. And all of this is really case by case basis, guys. If you come to us and, we can give you general direction on just, keeping good track of your expenses and doing it the right way. But we will look at your situation. We'll look at what type of expenses you have. Everybody's in a different and tell you. A big question I get a lot is home office. Can I deduct my home office? Well, it depends. That's the answer. It depends on what brokerage do you belong to? Do they charge you for a desk fee, or are you only allowed to work from home? So a lot of these things will be very individualized, that's why it's great to have someone to talk to even say, am I thinking about this right? Am I going crazy? The answer is yes, but it's definitely helpful to have someone, at least point you in the right direction there.
Awesome. All right. All right, guys, what else do we want to cover today? Is there something else that we want to hit here? I know we're coming up against 2 o'clock, but we've got a little bit of time, or if we have any questions from the crowd, I'd love to answer those.
We also need to talk, sorry.
Yeah.
We also need to talk about the reasonable salary real quick. Yeah. That is a requirement where the IRS giveth, the IRS taketh away. We've been telling you how fantastic the PLLC is. And the part that usually scares people is when we tell them, but if you're going to save all this money, you also have an obligation to run a reasonable salary, which means taking a payroll, getting a W-2, and that's where people go, I'm out. That sounds hard. Mm-hmm. But we will connect you to a payroll company. It's inexpensive. It's very easy, but that is a requirement. We like to see that reasonable compensation fall at around 20-ish% of your total profit. The reason that you have to pay a reasonable compensation is when you look at your role as an owner of this company, you are serving in 2 capacities. Number one, you are doing the work. You are acting like an employee. You're opening the door. You're showing property. You're scheduling tours. You are, meeting inspectors and appraisers. You're doing work that you could hire somebody else to do. That work is what we have to pay you for. That is a reasonable salary for your physical contribution to the business. Your second role is as owner, where you have contributed capital, money to the company. and you sit and wait for your reward. Think of this as if you bought stock in Google. You don't work at Google. You don't make any decisions at Google. You don't have any authority, but you've given them your money, and in exchange, you get a dividend or a distribution. That is passive income. That means you don't have any active role. You aren't a decision maker. You aren't in day-to-day operations or management. But so that income that you earn is passive income, which is exempt from the self-employment tax. So there is a 70 or 80% amount of your income coming off of the PLLC that is your reward for investing in this company. That is how we save the 15.3%, because it's a dividend or a distribution from your ownership activity in the company, which is different than the work that you've contributed.
Okay.
That looks clear as mud.
No, I make it. You know what it does? So all of this does sound pretty complicated. I know that it's straightforward, but it's not something for lay people just to get into, and the consequences can be pretty high for not doing it right. And I know this from experience, because in any time that I've had to deal with Department of Business and Professional Regulation, that I've had to deal with the Florida Department of Corporations, these have been not the prettiest
unpleasant experience.
And you know, and so do you guys offer a service in which you could maybe help somebody out if they said, okay, this is not our cup of tea, but you guys sound like you know what you're talking about? How could people get this set up correctly right out of the gate so they can get back to the real work they want to do?
So just like anything, it's soup to nuts, and it's a flat fee, which people enjoy. And that helps us guide you through the entire process. We answer all of your questions. We do everything that you need for formation. We get your local business tax. We get your S-Corp election. We take care of your renewals. We allocate you properly. You get an operating agreement, which people say they don't need, but remember Morgan & Morgan. And we do all of that on a flat fee basis. So you don't have to worry. We even go as far as ensuring that your brokerage has properly acknowledged the switch from your license. So you're not twisting in the wind there. The only thing I will say is we are in or we are out. It's not like, well, you do it and then you call us and we'll do one part. We don't need 5 cooks in the kitchen, and that becomes too messy. So we prefer either to give you the form and let you have at it, or have us do it, but we don't really want to both do it. That's, Maureen always says, if you pay to watch me do it, that's bad.
That's right.
If I pay to watch you
to review and fix your tax return is going to cost you twice as much as just me preparing it.
Yeah. That's very true. So
yeah.
Okay. All right. So how can somebody reach out to you? What's the best way for them to find you guys?
So we can provide our email addresses and our phone number. Our phone number at the office is 941-225-2615, and you can call one number and get both firms. We are all under one roof, and we operate as one business. Marina and I are constantly approaching everything in a team effort. So you get business and tax and real estate all in one. My email is Joanne, JOANN @Koontz, KOONTZ, associates.com.
Love it. And then Joanne, you had mentioned earlier a tax deductions for realtors worksheet, or Marina, you mentioned it. I do have a copy of that I actually have, and I did post a link. And that was from one that you guys did for us just earlier. So it's recent information, but I have it. I posted it. If people want to download it, just go look back in the comments. You'll find it there. And we're going to post this video to our website and make it available for you guys if you want to watch it again, or if you missed the beginning part of it, or if you want to download that, we'll have the link there for you as well.
Perfect.
Okay.
Thanks for your help. If anybody has any questions, you're welcome to let us know.
Yep. Right now, I think we have made it through the session, and it looks like we don't have any questions that are coming in. I appreciate your time, guys. You guys are always wonderful, and I appreciate it. And let's come back and let's do this again real soon.
Perfect.
Sure.
Stay
Thank
safe
you so
and
much,
stay busy.
Alex.
Bye.
Bye, guys.
Bye.